On this episode of Through the Pines, we will cover your year-end financial checklist. Now, it's not what you're thinking. This is like good stuff here. It's not like we're covering a financial plan for you. We're covering what you should be doing now that it is towards the end of the year, like maxing out retirement contributions, harvest investment, taking required minimum distributions, charitable gifts, deferring income. What are your Roth strategies? What about spending FSA funds? Should you rebalance your portfolio, evaluating business retirement plans, updating your estate plans, and finally, reflecting on what your financial goals actually are, rounding out this year, moving on to the next one. Welcome to a financial planning podcast with the down-to-earth vibe. Sasquatch listens while buffing out his vintage 911 Speedster. This is Through the Pines. Our advisors for this episode, we welcome back Rex, Baxter, and Brandyn Smith from planwithbaxter.com. Famous, planwithbaxter.com. If you haven't been there, you got to go. They are the 2023, 2024, and 2025 Forbes Best in-State Wealth Management Teams for Utah, Advisor Hub's fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award, which means they know what they're doing in the business. Rex, welcome back to the program.
Hey, thanks for having me. Yeah. I would also like a 911 Speedster.
Same. It's like one of my dream cars.
Yeah, so, mine too.
Yeah, so that's why we used it in the thing. All right, so let's dive into the end of year financial planning checklist. Now, this is something that everyone should do, but I didn't think about this, and I host a podcast for doing this. So now I thought about like it in the sense of like, it's what did we do last year, and how can I do better next year? But not about these things like, there's a certain amount of months where I can max out my retirement benefits.
Yeah, I think there's a lot of things that people kind of let slip by, and then all of a sudden it's January 2nd, and they're like, hey, can I do this? And unfortunately, it's a calendar year deadline and not a tax year deadline. And so as we go through today and we talk about this a little bit,
if you don't get anything else, I think that's the most important thing you said. It is a calendar year deadline, not a tax deadline, because that's what I think too. But I haven't filed my taxes yet.
Right, but some of these things you have to get done before the end of the year.
Okay.
And so probably the most important thing I'm going to say.
Yeah.
Well,
wasn't even said yet.
Is make sure you schedule a year-end review with Plan with Baxter.
Go to planwithbaxter.com. Year-end review. But you can help people do this. This is what you do. Both of you do for a living, and this is why we have you on the program to talk about why it's so important. So, maxing out your retirement contributions, Brandyn. Why is this important? IRA, 401k, your deadlines and stuff.
Yeah, it's important to keep track of it, and I'll say with that, like with our clients, when we're meeting with them in April and in June and in August, right? Like we're looking forward, and there are some clients that I'm like, okay, we want to do this Roth conversion, right? And so I'll set a reminder, and I'll just did that the other day, right? Called them and is like, oh, did we miss a meeting? Like, nope, we talked about this. We want to talk about our conversions towards the end of the year, right? And so they're usually we're just kind of with our clients, we're just scheduling follow up, or it's not like we're meeting with every single client in December trying to like ram stuff through. But with retirement contributions, so 401ks, that's a calendar year deadline. That if you're trying to save into your company's 401k plan, we need to do that through the calendar, and not only in the calendar year, but you have to do it via payroll. We can't just like pull money out of a bank account and drop it into your company's 401k plan. And so we really need to
know that. So you have to tell reach out to your 401k company, I guess?
So probably your HR department. Say withhold X%, or a lot of them handle it through like the 401k.
One-time only thing or something.
Yeah, payroll for the next 3 payrolls. I need to increase it X% in order to make sure I maxed it out.
Yeah, 80% of my paycheck, right? And we've helped people do that when you're trying, because you can't just lump sum it in. Obviously, you've got the maximum amount. So if you're under age 50, it's $23,500. If you're over, it's $7,500. Just a reminder, going into 2026 and beyond, that catch-up, if you're over age 50 and you're trying to do that catch-up amount of $7,500, that has to be Roth if you've made more than $145,000. And so that's something to kind of keep in mind, is that we've got some changes with that.
Also, keep in mind you have your super catch-ups for those that are ages 60 to 63.
I totally just thought of like hot dogs.
I know.
Super ketchup.
I know. I know.
Super fancy ketchup.
Super fancy elevated ketchup for those ages 60 to 63. You can put in a little bit more.
And what a weird number, right?
Random.
Ages 60 through 63. you get that extra. So the extra $11,250.
A good thing is you get an email from the government that tells you these things. Not.
Yeah.
No, but most of the time we have newsletters that go out to our listeners.
Okay.
That
Like
a lot of times
open those?
have these things.
Yeah,
So if you
okay.
open them and read
Read
them,
'em.
typically there's a good informational nugget there for you.
So that's the 401k, but then you've got your IRA, and your IRA, you can make an IRA contribution until the tax deadline, the April 15th.
That's nice.
Or when you file your
That's
taxes,
nice.
whichever.
Okay. Gives you a couple months.
Yep. And so if you get into a place where like, oh man, I wish I could have saved more, or reduced my taxes for the year, you can still do that in an IRA with certain caveats, right? And we won't go into them this time, but
So if you don't have an IRA, could you start one and backdate it or put it for the last year and then do like a...
Yeah, you can do a prior year contribution
Yeah?
up to your tax filing deadline, and that's on IRAs and SEP accounts, self-employed pension plans. And so both those go to a tax filing deadline. And so, but it can get really confusing and convoluted quickly for a lot of people as to, okay, which ones of these are year end, which ones are tax end. And so a lot of times this is the time of year when you want to hold a joint meeting with your advisor and with your tax, professional, your CPA, to make sure that we're getting everything done by the end of the year that needs to be done by the end of the year.
Okay.
Specifically if you haven't had several meetings during because most of our clients, right, we've got this dialed in. We've got a monthly pull from their bank to max fund the IRA. We've got their 401k set up, and so it's really not, we don't have to last minute try and change everything.
Yeah, so we're speaking to those of you listeners that are not our clients.
That's true.
Not current.
No.
And maybe you should be. Come on. Brandon, what is a harvest investment? This is something that it's like October, November, harvest is coming.
Yeah, the harvest.
Yeah, the harvest.
Similar, yes.
I saw this on the list and I'm like, I have no idea what this is.
Yeah, tax loss harvesting. So kind of fun. And this does usually need to be done more towards the end of the year. And so if you're having, and I'm, right in the middle of doing it for several clients right now, where I had one client who switched his job, right, and went several months without employment, and we were pulling from other sources, but essentially his income's going to be really low. And then he also happened to have quite a bit of capital gains in his investment account, so we've grown the accounts a lot. We've got a lot of long-term capital gains, and I looked at that and said, man, we can sell all of these, recognize them in a 0% long-term capital gain bracket. Some of them we had to wait for a month, right? But essentially,
because his income was so low.
Yeah, we're recognizing tens of thousands of dollars of gains at a 0% bracket, right? And that's a really beneficial. The other big one though that we run into a lot of times is if you got an overall stock portfolio and maybe someone's had a really good year, they've got tons of income, but we can actually offset some of the gains by selling some of the positions that are in a loss position.
Brandon, have you ever said to someone like, probably shouldn't work this year? Don't work this year. We'll take the gains, or what? You know what I mean? Like, what are the numbers there? Is that ever beneficial to someone?
So that's the no, right? Like you're not going to come ahead by missing out on.
I have.
You have? Are
You
serious?
told someone not to earn money?
Well, we did because we were trying to. So they're semi-retired, right? And so we're trying to hit a certain level on their health care.
Yeah.
And they can only earn up to a certain amount before they lose some of those tax credit premiums on their health care. And so we have to keep his income under a certain level amount. And so come September, it's like you can't work anymore this year. You need to stop working because the amount that you work is now we're going to lose all of that benefit through added expenses.
Yeah.
And so we're going to be going backwards.
Right.
Yeah.
And then
so there are situations like that.
Then you can offset that with Roth distributions so they can still keep their lifestyle but not show the income.
It reminds me on a more basic principle, I guess, of when childcare, and it's like, and then like you've got one spouse maybe working for full time and the other one trying to work, but it's like it's not even worth it because as much as we pay in childcare, I might as well just stay at home and watch the kid or something.
Right, we're just going backwards.
We're just going backwards. Yeah.
Yeah.
Yeah, definitely situations like that out there
Okay.
that we need to be aware of.
But that's where having those regular meetings with advisors, when you're meeting that, because clients don't think about that right off the bat. Like, yeah, I kind of had a bad year. And when you're talking to people and you say, oh yeah, well, what is a bad? Where's our income? And you look at it across the tax brackets, and maybe there's some opportunities there. Mm-hmm. And so I've personally never told someone, yeah, just don't work because we're gonna. But I have said, hey, if we have a lower income year, we're going to talk about these things.
Yeah.
And you keep track of that.
It's on the radar.
Yeah.
Yeah. Okay. What about taking the required minimum distributions, RMDs? I always think of, Rex, you probably get this, the ROUSs from... Oh, Brandon left first. Wow. Princess Bride.
Yeah.
RMDs, totally not the same thing, but whenever similar, you say similar? Yeah, but you have to, these are things you have to do, right?
Yeah. You have to take a required minimum distribution.
Required is in the word.
It is in the word. And so, the first year they allow you a little bit of grace to where you can push it into the tax filing deadline.
Well, April 1st.
April 1st. Yeah, not even tax filing
Which
deadline.
is so weird.
It's April
Why
1st.
not give them till the tax filing deadline? You're going to, anyway.
And so that
Another 4 days.
Then
Right.
if you do that, then the following year you have 2 required minimum distributions that have to be done during that calendar year. And so it can jump up your income that year. After the first year, then there's a minimum required amount each year thereafter. And this is typically impacting those that are 73 and above right now.
Yep.
Or if you've inherited an IRA and it's in an inherited IRA account, then you have to take out a minimum amount every year as well. And so you don't want to miss that. The penalty, if you miss that, I believe they changed that to 25%.
Yeah.
Of the amount that you're supposed to pull out. So if you're supposed to pull out 10 grand on a required amount and you take it out January 2nd instead of December 31st, then it's a $2,500 IRS penalty.
That's rough.
So we don't want to miss those.
Okay, Brandon, anything else on the RMDs?
Required minimum distributions.
Yep. You just make sure that you're taking them, right? And you're keeping on top of those things. And so for us, right, we've got our list of clients. And so we, especially towards the end of the year, if we haven't taken them already, we're spending some time going through the list, making sure everybody's pulled the right amount out. And usually people always have questions about this if they're not RMD age yet. It's on pre-tax assets like traditional IRAs, traditional 401ks, and usually starts around about 4% of the portfolio value that they're requiring that you take out each year. Right. And the idea is that the government just says, hey, you haven't ever paid us tax on this. It's about time you start paying taxes on it. And they're forcing that out. You don't have to spend it. You can reinvest it into like a non-qualified account, but they're going to require that you pay tax on it.
So the government wants their money back?
They want their money back. However,
whose money?
One
Wait
thing.
a minute.
Yeah. Getting into the next subject, charitable gifts or QCDs.
I want to follow up on that one.
All right.
We'll move on very quietly and calmly.
Yeah, Brandon, move us on, please. I don't even know what a QCD is. So,
Qualified charitable distribution.
Okay.
And so what that is that's where you pull money from an IRA and you send it directly to a qualified 501c3 charity. So most churches, most charitable organizations qualify as that. And so what you can do is you can actually move money from your IRA to the charity and not recognize it as income. Why is that such a big deal? Well, today the standard deduction is it used to be that people would give to their church or give to their charity and they'd get a little receipt and they'd take it to their accountant and get a tax benefit for that charitable contribution. Still to this day, I think a lot of people aren't realizing they're still getting the receipt. They take it to their accountant throws it in the trash, right? Because it doesn't do anything. The standard deduction is so high that if you're married filing jointly, if you're not giving, if you don't have enough interest and charitable contributions to exceed $30,000, then it just doesn't matter.
Yeah.
And most people don't realize that.
Yeah.
But with a qualified charitable distribution, you still take your full standard deduction. But since it went directly from your IRA to the charity, you're effectively getting that charitable deduction in net away, right? Because you don't recognize the income. Now, we always have to specify giving to charity is not making you money, right? You're never going to give money to charity and come ahead because the tax break was so great that you come out ahead. That's never going to happen. However, if you already are charitably inclined, if you're already going to give to a charity, doing it via QCD makes a lot of sense. Catches, you need to be 70 and a half years old to do this, and you need
older.
Or older.
Because that's like a day.
Yep. Right. Yeah, 70 and a half or older, and you need to have those pre-tax, traditional IRA style assets.
Okay.
Sometimes as we look at those qualified charitable distributions, we'll work with the tax accountant and because sometimes people will be right on the edge, right? They might have 29,000 of itemizable deductions, and so in their mind they're like, oh, well, I'll take the standard at 30. And they still want to give $5,000 or $10,000 or $15,000 to a charity, and so if they run that through a QCD, they're getting the $30,000 deduction, and then it's coming out of their IRA tax exempt, right? Because it's going to the charity. But had they not taken it out of the IRA and they ran it through their normal stock portfolio or investment portfolio, then all of a sudden, instead of taking the standard deduction of $30,000, they'd be taking a deduction of $35,000, $40,000, $45,000. And so, it is something that you want to look at, and it is something that you want to make sure you understand the numbers. It's not one of those where, the rule of thumb is I do this, and just a check the box and do it. It's a talk to your financial advisor, talk to your CPA, and make sure that we're all on the same page so that we can minimize those taxes with you.
Okay. Very good. What about deferring income, Brandon?
Yeah.
If beneficial.
Yeah. And I guess one other thing I want to go back to with the charitable gifts are the gift tax exclusion. So you can gift money each year to an individual, $18,000 per recipient, and not have to report that for gift taxes. And so that's something that is good to think about, right? If you're trying to move, and that's essentially people trying to move large amounts of money out of their estate and give it to kids or grandkids.
Is this state dependent or is this?
That's federal.
Okay.
Yep. And so you can do that per person per year. And so like if you've got one couple giving to another couple, then all of a sudden it's that 18,000 times 4.
Okay.
And that amount raises each year, give or take.
Yeah, it's adjusted for inflation.
Okay.
I think on the gifting, when we're doing the gifting, the 18,000, what we see a lot of times is somebody may have appreciated stock, right? They may have bought a particular company, ABC company, for $10,000, and today it's worth $100,000. So they have all these embedded capital gains that if they sell it and give cash, then they have to pay the capital gains on it. But what we see a lot of times is they may give that to their 25-year-old who is just out of college and may have a smaller income and may be able to sell that stock at a zero capital gain basis. And so they'll give that stock to their kids. Their kids can then sell it, and the family has avoided the capital gains tax. So
you guys are so smart. I love this.
We're such
stuff.
nerds.
Yeah,
Aren't we nerds?
I mean, it's why I love this stuff, obviously, but I also don't want to have to learn. Like, I don't want to have to remember all these things. I want to be able to call you, like that's
right.
And when we run through scenarios like this, it's like, that's why these people exist, because they know all these things that I don't want to think about on a Tuesday afternoon or whatever. You know what I mean? Like that's
right.
That's why we do it. So, okay. All right. Deferred income.
Yeah, so and this one can be a little bit tricky, right? And you want to coordinate this with your tax advisor, but there are various ways that we can defer income. The most basic being a 401k plan, right? If we're close to retirement, you just defer it. You put in a 401k, effectively defer the tax until later in retirement when hopefully you're in a lower bracket. But then there's, different deferred comp plans and things that you can do. And so, you want to do that before the end of the year and make all those calculations so that we can, a lot of times with clients, we'll kind of run through and say, all right, how much income have we made so far? How much more do we have? We think we're going to come into this bracket roughly by the end of the year. Does it make sense to try and defer some if that's an option?
Okay.
I think in addition to your deferred income would be, and I don't know if this is on, the list to talk about later, but is bunching of your deductions, right? To where you may want to, if you have a business expense, or you're making a charitable contribution, you may want to do 2 of them this year and double up in order to maximize. We get a lot of people that will do that, so that again they're going above the standard deduction. Instead of $30,000 on the standard deduction, they're putting enough deductible expenses into this year to get up to 40, 50, or 60 this year, and then they don't have those deductions for next year. So next year they'll take the standard deduction, and they kind of bounce back and forth year in, year out to again minimize those taxes. And again, that's coordinated really well, both with us and with your CPA.
Yeah.
But
yeah. Oh, by the way, pro tip: have a really good CPA.
yeah, pro tip. One that'll take your calls in November.
Yeah, and they're not on vacation. What's the vacation month for CPAs? Is there one?
Right after the tax filing of,
like
April
June
15th,
or something?
Well, April 15th, and then you get after
Well, you've got
October.
April and May deadlines, tax deadlines.
Yeah.
You have September and October tax deadlines, and so typically it's in between those gap areas.
Okay. All right.
But-
Just in case you're calling and can't get a hold of them right now.
Yeah.
Brandon, I was supposed to tease some more numbers at the beginning of the podcast.
That's right.
Because
That's
we
right.
got feedback.
Next time.
Yeah, that we should tease it earlier on. So I am teasing it now that after we consider our Roth strategies, we'll give you some more numbers, a little something tasty to look forward to. But let's dive into the Roth strategies. And you sort of touched on these, Brandon, but the Roth conversion and the back door and the deadlines.
Yeah, so Roth conversions I enjoy these a lot.
Like good times. This is so funny. You guys love this stuff. I love it.
A lot of people really love going to parties and concerts
talking about-
and different things like that.
Listen,
Hey, we
We get excited about Roth conversions.
I'm glad you have another person to talk to about this. I interviewed someone for my Ascent Life podcast, and I'm wearing the hat. It's a great podcast. You can listen to that. Teaches you how to become your best self. But she is... she leads like a nonprofit that works on recycling printer drums, and they geek out on toner cartridges. And I'm like, she goes, well, I don't get invited to many dinner parties, because it's like, who are you going to talk? But yeah, it's like you guys can have talk for hours on Roths and all the intricacies of this kind of stuff. And it's a good time.
Yeah, I haven't been invited to dinner for a while. No, I'm just kidding.
Stop it. Rex is a good time outside of this podcast. Just so don't let him.
Nothing but fun.
Yeah. Anyway, all right, Brad, I'll let you expand on this.
It's fun because of the freedom and the feelings that it gives, right? It's like when you watch, I don't know, when you watch things that are just very satisfying. Like it's a very similar thing when you because it's what's fun about Roth conversions is it is very black and white. It's so much of what we do is very emotional, and it's very like, well, and there's if, and it's this. But like Roth conversions are, all right, where are we at this year for our taxes? And we look and we calculate that. We look at how much income has been made, roughly what tax bracket that should put them in, and then we can project it and say, all right, if we're in this, let's say, for example, in this Roth conversion strategies can happen at any time, right? And I've seen people do them in all different age brackets. But one of the most common ages is just after retirement. So let's say you retired age 65, you don't have your required minimum distributions until 73. That usually gives us that little maybe 8-year window of time where their income drops because they stopped earning income, right? But they haven't had to be required to take a ton of distributions out of IRAs. And so that income drops. And let's just say like a household happens to be at like $100,000 of income. And they really don't hit that next bracket that they're in a 12% federal tax bracket, and they don't hit that next bracket for another $23,000. Give or take, right? Mm-hmm. We can do a conversion of $20,000 at a 12% rate, move a bunch of money from pre-tax to Roth where it's going to grow completely tax-free and only pay 12% on that. Well, what does that do for the client? Well, it gives them certainty, right, that we've got a bunch of money that we could pull from completely tax-free in the future if we need to. Mm-hmm. And then it gives them just that piece of, like, people like having Roth,
sure,
right? And to know that, man, we got this converted and we got the taxes paid while we were in a good bracket, that feels really good. And so Roth conversion, that makes sense, for retirees. You got people who maybe lose a job, right? And we're like, hey, let's do a big Roth conversion. We got a low income year. Let's convert a bunch of this over. And if you play the system right, you can get to where you're doing all these Roth conversions when you're in low income years. When you're in high income years, you're effectively deferring that payment of that tax until another year when you're in a lower one. And it's just kind of a fun game, right? That's a lot more black and white than a lot of the other stuff we do.
It's like tax chess.
Yeah.
That's
Right?
a good way to put it. Tax chess. Good
Yeah.
times.
It's a new game
Yeah.
we're playing.
But it's fun when you show people how much you save.
I want that board game.
Yeah.
Tax
I
chess?
actually, because Monopoly is one of my favorite games, and if you know what it is, it's like it's business, so
Right.
it's real estate. You're buying and selling stuff. So, but can we make tax chess fun?
Then we
Right.
think about it. Yeah.
Yeah.
Well, I like it.
Yeah,
I have fun.
yeah. Hey, I can't remember do Roths have RMDs or no?
No. Well, when it's your Roth, it does not. An inherited Roth IRA does have RMDs.
Oh, okay.
However, you're not required to pay tax on it. You're just required to take a distribution.
Okay. I was just curious about that. All right, now the time has come, Brandon, for our s'more
Dun, dun,
numbers.
dun.
Our long-awaited.
Yes.
Drum roll.
That's good.
There's the audience.
Yep.
So this comes from the Census Bureau and First Trust. They actually track it's private office construction, but what they did that's so interesting is they actually broke that in between general private office construction and data centers.
Okay.
And so obviously data centers with a lot of the AI and these AI is so fun. But I don't think we realize how much energy and data center, right? This is not just a cloud-based, tool. It's a very hardware-intensive tool. And so anyway, it's kind of interesting. You can see over time, right, as that general construction has actually started to come down, the data centers have really ramped up, specifically since 2023. You've seen a huge, to where they haven't quite met, but they're close to it, right? And probably do here in the next year or so. And I think that'll be an interesting trend to watch as data centers become the new, like the new infrastructure of business.
Are you guys investing in data centers? Like,
There's companies, and obviously we're not going to mention specific companies and things like that, but there's definitely companies that their core portfolio is data centers. And whether it's for cloud storage, for server use, and a lot of times those are very long real estate leases that companies are entering into because they don't want to have to move from one data center to another. That's an enormous corporate expense to have to do that. And at risk of damaging things and losing data. And so that's a massive expense. So there's definitely companies that are involved in that.
I think like 30, 50 years from now, whatever, when the technology changes, because it will, you're going to have all these empty data centers because you're going to have like smaller
I think so too,
and better.
at some point.
Yeah.
I don't know how far out that is.
Right.
But
Real estate's going to go to, it's got to change, right?
Yeah. At some point it'll change. So it'll be interesting to see who takes up that real estate space down the road, because something else will come along that will take up that space. But it'll be interesting to see if it's
right now it's hot
go-karting track or what it is. I don't know.
What a life that would be.
Oh yeah, and the go-kart guy's just like, oh, I can't wait. Oh shoot! All right, it's wild, Brandon. Yeah, cool, good stuff. Okay, so the spending on remaining FSA funds, this is something else you should do at your year-end financial checklist. You use it or lose it.
Yeah. So you got FSA and HSA.
Okay.
And sometimes those get confused, but FSA is a use it or lose it.
What is FSA?
It's for health-related
Flex
expense.
spending accounts is what FSA is.
Thank you. And the FSA, though, it's a use it or lose it. So you designate how much you want to put in, you get a tax deduction for that, but then you need to spend it down, by the end of the year. Whereas HSA, you can actually carry the balance year to year.
Yeah.
Now with an HSA, there's still kind of those limits, right? Because we want to fund get our HSAs max funded because we get a tax deduction for that, and we can continue the balance on. You actually have until your tax filing deadline, or April 15th, when you file your taxes, to contribute to your HSA. Now, one thing that a lot of people don't understand about the HSA is, yes, we can lump sum. We can say, oh man, we got another $5,000 we can put into our HSA. Let's just like dump that in from the bank, right? From bank savings. You can do that, and that's fine. But you'll still get your federal and your state deductions, but you miss your FICA deductions. And so if you want your Social Security, Medicare taxes to be deducted, or get that deduction, you need to do that through payroll through the year. And so it's a lot better if you can, right, to kind of calculate that at the beginning of the year, and January through December make your full HSA contribution.
Okay.
Yeah, I would argue that maxing out your HSA is one of the most valuable tools that you have.
Yeah.
To max out. And so, we want to make sure that people are doing that. But we also don't want to leave money on the table. If you've dedicated, $5,000 to go into a flex spending account, and there's some other, different companies will have different use it or lose it benefit packages in there that you need to be aware of. And so if there's something in there, you don't want to lose that at the end of the year and just have it go away and not be able to utilize it. So make sure that you're looking at that well before the end of the year.
Money.
Well, it's your money that you've put in there.
Yeah.
And you're going to lose it if you don't spend it. So.
Okay. Yeah, that's important to remember this. All right. Well, I'm assuming you can rebalance your portfolios at any time, but at the end of the year, it's always a good time to check on your portfolios and decide whether you should do that or not.
Yeah, it's a good time to evaluate it.
Yeah.
Right. And depending upon where you're at from a capital gain standpoint, where your income's at, will help determine whether you want to rebalance that or not. Now, we always say that we don't let taxes control our investment decisions. However, we want to invest with taxes in mind. And so if a stock or a mutual fund, if there's a reason you need to sell it, then you sell it, right? Regardless of what the tax impact is going to be, you take care of that. If it's something that is doing fine and it's a positional change that you want to make, then you're going to let taxes kind of influence whether we do it in the middle of December or do we wait for 2 weeks and do it in the middle of January. And so, we want to invest with taxes in mind.
Can you just, for me, for those, just do it for me, Rex.
For the little people.
Yeah, for the little people.
Just
appreciate that. What does rebalancing a portfolio look like? Like, what does it mean? Like you're not,
At a really high level, we're selling the stocks that have done really well, and we're buying the stocks that are down, right? Or the mutual funds that are down. So we're selling high and buying low at a really high level. That's what you're doing. And so sometimes we're subbing in or out a position that we want to change, or we're trying to get additional exposure, maybe internationally or to emerging markets, or maybe to some sort of alternative investment. And so sometimes it's adding in or out of a position. But for the most part, we're saying, hey, look, in this portfolio, we want maybe 2% weightings in the different stocks. And this stock is at a 4% weighting. This stock's at a 1% weighting. So we're going to sell the one that's high, and we're going to buy the one that's low and average in.
Okay.
So.
And over time, statistically, that really helps portfolios grow.
Yeah.
What's funny is that when you talk to people doing it on their own, they do almost the opposite. They look at what's done really well and maybe skirt a little bit more into that one, and then and pull it from the one that maybe hasn't done as well, and they sell the ones that haven't done very well. And so fundamental to that is understanding why you own each asset class and where it's at. And because do we own every asset class? No, but we want to make sure that we're like coordinating that and making a very conscious decision as to why we're buying and selling and where we're allocating funds.
So you're recommending to do this at the end of the year. Now, if you do it daily, that's called day trading. But if you, can you do it too much? Like, can you do it 4 or 5 times throughout the year, or is like once a year a pretty good pace for something?
So there's a lot of studies that show that once to twice a year for rebalancing is more optimal than more frequent. Okay, is what the studies show. And so I think you can do it too frequent, which is interesting because some of the robo-advisors are like, oh, we rebalance every week. We bring it back into equilibrium every single week. Or on others, we see some robo-advisors sometimes, what we do is when the market's down, we're de-risking the portfolio. And that's a fancy way of saying...
Well, that sounds so good.
It does sound good until you realize what it is.
But essentially, when the market is down, you're selling the market and buying more conservative things, which means that when the market recovers and rebounds, you don't have as much in the market.
Yep.
And then their pitch is, well, yeah, but once the market is recovered, then we're ad risking, to the portfolio. And it's really the opposite of what,
should be done.
Should be being done. So
Okay. Interesting. What about business retirement plans, Brandon? Why should we evaluate these annually?
Yeah. So there's some things specifically like a simple IRA. If you make one simple IRA contribution in the year, then you've got a simple IRA for that year, and you can't switch it over to a SEP IRA or a 401k and so there. Each year, depending on what kind of what kind of retirement plans you have access to, that will change, what other plans you can change to, what other IRA contributions you can have. And so, towards the end of the year, it's not a bad idea to look at that and say, hey, is this retirement plan still serving my needs the best way possible? And do I want this for another full year? And a lot of times the answer is yes. We looked at this last year, we looked at it the year before. This is what I want. This is why. But then every so often it's like, well, actually business is better. We're growing more. I want to start saving more. And so, if at the end of the year, it's a good idea to kind of review that and say, hey, do we want to stop our simple IRA this year and this be the last year and start a new retirement plan for next year? Now is the time to, end of year is the time to review that.
Planwithbaxter.com.
There's a lot of business retirement plans are fairly complex. And so we work with a lot of our entrepreneur clients, a lot of our business owner clients throughout the year to be working on these things, because sometimes if you're going to start up a brand new plan, sometimes we will have deadlines in October of getting those initiated so that we can start them on January 1st, because some of those things take more time. And so a lot of these with our current clients, we're working on constantly throughout the year. However, if you're not one of our clients and you're not working with us, these are definitely things that you should be addressing and looking at during the, if not during the year, certainly during the fourth quarter.
Yeah. Okay. Very good. Updating, of course. This is a great time of year to do this, your estate and beneficiary plan. And the overlooked one that I've learned from you guys in producing this podcast over the years is the beneficiary plans. Because you can go years without relooking at those at some point, and then ex-wives get all your money.
Yeah, unless you're one of our clients.
unless you're a client.
So that is something when we meet with our clients at least once a year, we have a beneficiary review.
Yeah.
And obviously sometimes clients miss meetings, things come up, right? But for the most part, we're reviewing beneficiaries. And does that need to be done at the end of the year? No. But it's not a bad idea if you're going to have a checklist once a year, to touch base on the beneficiaries and gifting strategies and things like that.
Change your filters. Check your beneficiary list.
I think you're supposed to change your filters more than once a year.
Like once a month. But put it in your calendar to do that. And that's funny. Okay, and then update obviously your estate plans.
Yeah, those should be reviewed on an annual basis as well. And just as anything changed, normally we don't go through a deep review of your estate plan for every 3 to 5 years, but you should do kind of a surface level. Has somebody passed away? Has somebody been married? Do we have a name change? Are we writing somebody out of the will or trust? All those things, right?
Yeah.
And so we want to review those, make sure that we have the documents in place, make sure we know where to find them, make sure that, the people that need to be able to find them.
Isn't there a prince that's no longer a prince? Like he's probably getting written out of wills now.
Oh, yeah.
Yeah.
Yeah. There is. So
it can't happen.
I think he lost his title.
He lost his title, and the Duchess lost her title. She can no longer be the Duchess of York, even though they've been divorced forever. But yeah,
right.
But some people do it. This was years and years and years ago. We had a client that she called in. I think it was like every other month. It's like, and here's my new list of beneficiaries. Based on how the last family party went. And
oh no,
and she was just always shifting around.
I'm still in shock every year, right? That some celebrity will pass. And they just have a simple will and not trust, or they don't have their entire estate plan in order. I mean, are these people not listening to us?
So I am going to email them the podcast, because they definitely need to be listening to you and talking to Plan with Baxter.
CCS on that.
Yes, yeah. But that's essentially is they're busy doing other things like so many people are, and they just they don't address it. Now they've got, or their family or their legacy or whatever has more to lose because there's a lot of money there, but it's important for anyone.
Yeah, it's easy to push that down the priority list when really it should be checked on regularly.
Yeah.
So
Okay. And finally, as we close out here, we're going to just reflect on our financial goals each year. Rex, how does, what do we think about? Like, what do you think? Hey, I'm doing pretty good. Like, what does reflecting on our financial goals mean to you?
It means a couple different things. One, did I make the right moves during the year to increase my net worth, right? Has my net worth gone up this year because of moves that I can control? Now, obviously, the market may control that to some extent, but the things within my power that I can do or influence, did that increase my net worth? Did I, as I set out my goals at the beginning of the year, whether it's max funding my 401k, whether it's, contributing to a donor advised fund, whatever those goals are, did I execute on them? And if I didn't, why didn't I? And what can I improve in my life the next year? How can I live my best life? How can I live
I've heard that somewhere. Yeah.
Man, somebody should make a podcast about that.
I think they have.
Okay. All right.
Brandon, you want to expand on that a little bit, reflecting on your financial goals each year?
Yeah, and I think this can be done throughout the year, as well, and whether that's a semi-annual review or whenever that is with your advisor. But I think it is good to look at the progress being made. How much did my net worth grow? How much are we progressing towards the goals? Just had a meeting the other day, right, where we ran their net worth, like, okay, good, and then we looked at what was your plan? It was like last year, and it was off by a couple months, but we looked at the plan last year and said, oh, wow, holy cow, like we've grown quite dramatically over the last year. And that can feel good, and even provide motivation when you're like, man, like I'm still stuck in the same, maybe I spent this wrong or I did that. But like when you look at the plan as a whole, are we progressing or are we not progressing? Are we stuck? And if we are, then let's figure out a way to get unstuck.
Yeah, for sure. Rex, Brandon, thanks for joining this episode of Through the Pines. This podcast was produced by the Banyan Collective in our camp trailer studio right here, located inside the Monarch Building, inside the Nine Rails Arts District on historic 25th Street. If you found value in this podcast, which I know you did, please consider supporting us at buymeacoffee.com/Banyan Media. That's Banyan. There's 2 A's in Banyan, Banyan Media. .com. Watch and subscribe to us on YouTube at Through the Pines, and you can find us on Facebook, Pines Podcast. We're also on Instagram, Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.